All right, welcome to our Finance Friday weekly wealth creation course. We're coming to you again this week to talk about credit. I am Jerry Fetta, owner, founder, CEO of Wealth DynamX, and we've got a little bit of a new studio going on here. So let me know if you guys like that. Thumbs up, likes, hearts, whatever you'd like to do. But I want to talk to you guys tonight about credit. Okay. Now, with the topic of credit, we have to understand first what it is. And I'm going to dive into a lot tonight. And so I want to really stress as I'm going through this course, this is an important one to make sure that you are looking up your words. You are asking questions when you don't know what I mean if I say certain terms or concepts or phrases. Also, it's a good one to, again, make sure that you are removing the barrier to learning of thinking you know it all already. Okay. Credit is unique in that it's easy for most of us to get, but I would say 90% of us don't actually understand what it is. Okay. So having something and using it does not replace knowledge. I still have to know what it is. It doesn't mean I know what it is just because I have it, right? There's plenty of examples of that. So make sure that you're focusing in on, the words we're going over, making sure that you understand those, you're looking them up, you're asking questions, making sure that, we remove that thought or that preconceived notion of I know this already because I have a credit card or because I have a mortgage. There's lots to learn on the topic of credit. We're going to cover a lot tonight. Okay. So those are things we always talk about. And then obviously, come from a place of production, not consumption. This is not a reality TV series or entertainment. I hope it is entertaining, but it is education. It's something that you consume with the reason to produce, right? Different than most things. Most things, you buy a shirt, a hat, a car, you consume them, right? This is one that the purpose of it is production. The reason why you're learning is to produce, to use the information, which brings me to my last point. And that last point is, I want you to think about what is your purpose for being here tonight? How are you going to use this information? Okay. Am I here, again, just to hang out, consume, be part of the Wealth DynamX group, watch the replay, whatever it might be? Or am I here really to improve my finances and to actually take the information and apply it? Okay. So without further ado, let's jump into the topic, the discussion of credit. Now, credit is one that to me is an interesting and fun topic to cover because my backstory is my parents actually got divorced over credit. Okay. Overspending, bills being overdue. Like I've talked about before, when I was 8, 9 years old, we lost our house because we were behind on the mortgage. It got short sold. My parents couldn't afford to keep it. Same summer, I watched my mom get the car repoed, right? They came with a tow truck. They pulled it right out of the driveway. Okay. So and I didn't know what credit was, but I knew that we had these things and all of a sudden these things were being taken away. And then my parents were fighting over them. And then finally they got divorced. Okay. And so as an adult, as I started to grow up, I started to realize, oh, we had a mortgage. The bank doesn't just make you sell a house. When you have to sell a house, it's because you're not keeping up with the mortgage, right? A mortgage is a form of credit. Right. Or secondly, the car, right? We had a car loan. People usually don't just buy a car with cash. They usually borrow money from the bank. And so when the car got taken away, it's because that was credit. And, the credit was no longer being utilized the way it was agreed upon. So the car got taken away. Right. So you fast forward, and that was my mindset. That was my thought on credit is it was this very dangerous and risky thing. So 18 years old, I get into finance and I start learning from Dave Ramsey, and I hear credit cards are bad. Debt is evil. Never borrow money. Never do anything with debt. It's the worst thing in the world. And I actually had like the justification to agree with that. Back when I was a kid, I was like, yeah, we lost the house because of debt, right? We lost the car because of debt. So I automatically knew debt was bad, right? I agreed with that. And that was what I was hearing. And I was like, yeah, I can line my reality up with that. That makes sense. So I didn't get involved with credit until I got into business. Right. So I didn't have actually before that I did get a car loan, but it was something where, I was very, very conscious of, okay, I know that I can't afford the thing, but I can make the payments. And I wasn't excessively borrowing. I had a cheap little car. My mom co-signed with me. That was my first loan. Okay. Never borrowed money again after that until I got into business. And when I got into business, I had to use a credit card one time. Right. And you may have heard this story. This was back in my old days when I was a Dave Ramsey rep. And I had to travel from Alaska to Minnesota about every 2 weeks. Okay. And so my second trip down there, and I've told this story before, but I'll tell it again tonight. My second trip down there, I had everything lined out. And basically, I was going to buy my ticket. I was going to buy my hotel room. I was going to rent my car. I would be there for a few days. I would close some business, meet with some clients, and then I would come back home. And I had, cash lined out for the whole thing. Only the car broke down the week of the trip. Okay, we had a VW Passat. If you've ever owned a VW, fun little cars, but very expensive to repair. Right. And so when the car broke down, that repair costs $2,400. Okay. Guess how much my trip costs? About $2,400. And so we had to fix the car with our cash. And so I didn't have the money for my trip. I didn't have money for a plane ticket. I didn't have money for a hotel room. I didn't have money for a rental car. And I remember a buddy telling me like, hey, if you get an Alaska Airlines credit card, they're really easy to qualify for. You get airlines miles. And I started then thinking about, okay, if I'm going to make this trip happen, I'm probably going to have to use a credit card. Okay. Not knowing what it was, not knowing how it worked. I just knew that you can borrow money on a credit card. So I did that. I got a credit card, got approved for my first one. I got a one-way plane ticket to Minnesota, 3 or 4 days in the hotel room, 3 or 4 days to the rental car, and no way home. Okay. And so I was basically in the position of, okay, I borrowed the money to go down there. I have to go down there and close business or I'm not going to be able to come home. So that was my situation. It's February, it's Minnesota. Okay. And I've talked about this before, but like I was not closing business at that time. I wasn't good at business. I wasn't good at sales. I wasn't very good at communicating. And so I was down to the wire. Like the day my rental car expired, I didn't bring it back because if I brought it back, I didn't have money to renew it. Right. And so I would basically be stuck in Minneapolis in the airport where I got the rental car from. I had one night left on my hotel room. And so I essentially stole or borrowed the rental car further than I was supposed to. Right. And my goal was, okay, I've got like 2 more meetings. I've got to close a deal or I'm not going to be able to go home. And also I'm probably going to get arrested for stealing the rental car. And also I'm probably going to sleep on the streets in Minnesota if I don't, because my hotel room expires tomorrow. That was the position I was in. And so thankfully, long story short, I closed a sale. I was able to get my ticket home, but that credit card didn't get paid off. Right. And so I started then like having this problem of I wasn't making enough income to pay off this loan that I took. And so I was late a couple of times and I had a few collection calls happening and it really started to like get at me. Like I need to get rid of this debt. I need to get rid of the credit cards. I need to never use this stuff again. Dave Ramsey was right. I should have listened to my parents. I should have watched what happened to them and never used debt. Okay. That was my reality with debt and credit from basically that was around the age of 21 when all that happens. Can you imagine that happening when you're 21 years old? That was insane. But that was what happened. And so I basically avoided debt. I didn't borrow money. I had my car loans at the time. I did not know about the Sacred account yet. So I was not self-financing my vehicles, but I had my car loans and that was really it. And I tried to stay away from debt, not even knowing what credit was. Okay. I just knew it was bad. Now, if you're watching this, you're in one of 2 schools. You're in the school of debt's bad because Dave Ramsey said, right? Or I had a bad experience with it or whatever the thing is, or debt's good, use lots of it, borrow, leverage other people's money, the whole Robert Kiyosaki rich dad kind of thing, right? Very polar opposites. Okay. And so what I want to talk about is not whether one side's wrong, one side's right. I want to talk about what is credit? What is it actually? What is it for? What should we use it for? What shouldn't we use it for? And more importantly, like, how do we gain financial freedom with it? We're not here to talk about, the benefits of one financial tool over another. We're here to talk about gaining financial freedom. Everything we talk about is gaining financial freedom. So with credit, the main question is, can it help me become financially free? If no, I don't need it. If yes, maybe it's something I should look into, right? But before that, what is credit? Okay, what is credit? Now, there's a lot of definitions of credit. If you look credit up in the dictionary or on Investopedia.com, you're going to see something along the lines of, when a customer takes delivery of a good or a service or borrows money that they don't actually have with the promise to repay it later, usually with interest, right? That's like a definition of credit, okay? But credit, what it really comes down to is, number one, I usually don't have money. This is where usually people get credit. I don't have money. Okay. Now, I'm not saying everyone is in this position when they borrow, but usually that's why someone gets credit. When I first borrowed money, it's because I didn't have any of my own. Okay. So then I go and I find a lender. So I find the lender. I qualify for the loan. Okay. So that's the next point. These might all sound very simple, but I'm going somewhere with this. And then I agree to the terms, and then I promise to pay. Okay, this is basically what credit is. So I promise payments based on these terms, right? So this whole process, if we look at this, I don't have money would be the first step. If you're borrowing because you don't have money, that's never a good reason to borrow. Okay. So if that's my lifestyle, that's my mindset with credit, I need to scratch that one right off the bat. I should never borrow because I lack. We'll talk about why tonight. Finding a lender. I need to realize that that is a lender. That's not a bank or an institution or whatever fancy name they want to give me. That's a lender. They're loaning me money, regardless of what their title is, regardless of what their building looks like, regardless of what their business card says. That is a lender. I am a borrower. Okay. Lender is someone who loans out money, funds, resources. Borrower is someone that receives them, agrees to the terms, and then promises to pay. Now, I find a lender, I then qualify for a loan, right? Now, this loan qualification process, what I want to basically look at is this is based on two main things: trust and obligation. Right? We talk about currency, right? We say currency is a medium of exchange backed by confidence. Right? It's a method of exchange and we back it with our confidence. Credit is a little bit different than currency. Credit is trust backed by obligation. Right? It's other people's money, other people's funds based on the trust that I have, backed by my obligation to repay them. That's what credit really is. Right? So I have to realize when I borrow money, it's not mine, it's theirs. There's no such thing as cheap money. A lender is never going to give you cheap money. They're going to give you money at an acceptable rate that they think is fair for them, not for you, for them. Right? So when you're going to a lender that gives you cheap money, it's because they have a lot of volume, right? They have a lot of money that they can loan out, a lot of currency they can loan out. And so they can afford to give you a 2 or 3 or 4% rate because they have thousands of those paying them every month. They don't need to make 8% or 10% or 12% on one loan. Okay. That can be good or bad. It's cheap money, but guess what? The lender that has thousands of clients and that much money is probably the most suppressive one. They have the most resources. They can make my life hell if I don't agree to their terms or if I default on a loan or I don't cooperate. Right? Versus, if Nano's here at my house actually, or if I borrow money from Nano and it's a one-on-one thing and I miss a payment, I can be like, hey, Nano, I'm late. Can you help me out? And usually that's going to be a little bit easier. Nano might charge me a higher rate for that, but it's more of a relationship. So we have to look at the lender aspect. They're looking at trust and obligation. I'm agreeing to the terms, right? So when I'm doing currency, like I'm buying stuff with currency, there's no terms. I can buy this cup and I never have to worry about it again. I don't have to pay anyone back. I don't have an interest rate associated with it. Nothing bad will happen if I don't use the cup the way that I agreed to. All of that's fine because I, free and clear, paid for the cup, right? So with a loan, that's not the case. There's terms. I have to pay them back this rate over this term. Sometimes they control what I can use the thing for. Sometimes they don't. They can call a loan. They can ask for, more money up front. They can ask for a higher rate, higher payment. And I'm basically not in control of what happens there. Okay. So that's the thing I have to look for there. And then obviously the promise to pay. Okay. Now this is the part with credit that you have to look at. Promise to payment is not just the honor system. Think about it. When you borrow money on a credit card, okay, it's unsecured, meaning there's not collateral. Why would that be? Okay, the reason why there's not collateral is because if I don't pay, my trust goes down, right? They're going to ding my credit score. They're going to take a negative remark and put it on my report and say, this is a person that is not trustworthy. They borrow and don't repay on time, or they borrow and don't repay at all, right? And so my trust is really what that's secured by. And if I ever want to be able to get money from another person again, my promise to pay better be there. And I better keep up with the terms and things I agreed to. Okay. Conversely, there's also obligation, right? Who's ever heard of, somebody, defaulting on a credit card and the bank sues them, right? That's an obligation, right? So they're saying, hey, there's this thing called trust. And if you don't pay us back, we're going to ruin your reputation with all the other lenders out there. We're going to put a negative mark on your financial, credit report card, your credit score, and your credit report. We're going to say this person is not a good borrower. They're not trustworthy. Don't lend the money. Not only that, we're going to, any one of the next things, sue you, garnish your wages, foreclose on your home, repo your vehicle. It's obligation. Okay. It's different when it's just trust, where it's just like, hey man, can you spot me $20? Sure. I'll pay you back when I can. That's easy, right? That's not like a very threatening position to be in. But if it's like, hey, yeah, I'll give you the $20, but if you don't, you have to give me your big toe. Right? Then I think more about, okay, well, do I really want the $20? And I point this out because I don't think a lot of people think about this before they accept a loan. They don't think about what's the obligation? What are the strings attached to this? Yeah, I have good credit. Yeah, I have a good credit report. But what's the obligation here? Okay. So this is really what credit is. Again, it's someone else's money, it's someone else's currency backed by trust and my obligation to have to pay. Those are always going to be there. And if I have bad trust, they're not going to loan me the money. And if I'm not able to follow through on my obligations, I'm not going to loan the money. Think about last time you tried to qualify for a mortgage. What did they look at? Right? Biggest loan you're ever going to get in your life, unless you're a college student right now, in which case I'm sorry. And actually, I saw a great meme today I want to share. It was a college student. He posted Sally Mae, which is the loan institution for college student loans. It said, Sally Mae, thank you so much for getting me through college. I don't know how I'll ever repay you. Isn't that great? So you do your mortgage though. What do they look at? They want to see your tax return. Why? Because they're going to obligate your income. They want to see your assets and liabilities. Why? Because they're going to obligate your assets and liabilities. They want to see what? Your cash position. What do you have in reserves? Why? Because they plan to obligate that cash reserve. They're only going to loan you a certain percentage of the property's value, which is why they want a down payment from you. Why? Because they're going to obligate the property. If you don't pay, they're taking away the house. They want to make sure that there's more there than what they loaned you. Right? That's the part that cracks me. You look at real estate deals and someone is like, we closed on the loan and my house is worth way more than I paid for it. No, it's not. Do you really think that the bank gave you, $500,000, right? And that your house is worth more than that? No, your house is worth what the bank decided to give you money for. Okay. Because until you sell it, you're never going to see any of the equity unless you use what we use on the first position home equity lines of credit. But even then, the bank is going to tell you 10% down, 20% down. Right. So these are all things and factors we have to look at with credit. Now, what is the actual purpose of credit? Okay. This is something I want to cover because I don't think a lot of people know the definition of it, which we just went over, right? It's other people's funds, other people's currency backed by trust with my trust, right? And my own obligation, financially speaking, right? That's a good working definition of credit, but what is the purpose of it? Okay. The first purpose of credit is to provide excess reserves. Okay, this is part of solvency. I want to have 6 months worth of cash reserves in my sacred account and my life insurance. I also want to have 6 months of available credit. Okay. This does not mean I'm going to charge my credit cards up. It doesn't mean I'm using it to leverage out at 0% to go buy flipping properties and whatever. No, it means I'm going to have 6 months worth of credit that I just leave it. It sits there. I'm not going to borrow it against it. I'm not going to use it. It's there for reserves. Okay. That's the first purpose of credit. The second purpose is typically going to be to increase cash flow. Okay. Increasing cash flow. What do I mean by that? Right. So we get our 6 months of reserves. That's awesome. We have that now. Usually people buy a home, right? And when someone buys a home, they usually are going to buy a 30-year mortgage, or they're going to just rent, or they're going to do a 15-year mortgage. Those are all very expensive ways of doing housing, right? A 30-year mortgage, it's principal, interest, taxes, insurance. PITI is your payment. That's a large chunk of income, right? And so that's typically going to be 25 to maybe 45% of your income every single month that goes just to your mortgage payment. Okay, if you do a 15-year mortgage, it's even higher. If you're renting, it's probably about the same as what a mortgage would be, right? So when I'm talking about increasing cash flow, this is the home equity line of credit. Instead of doing a mortgage, we're doing a home equity line of credit. That's going to reduce our housing payment typically by 30 to 50%. And so that's going to give us more money left over. Why? Because we're not saving 40% of our income yet. So we want to free up cash flow so that we have more money to save. Okay. So that's the second thing we use credit for. The third thing that we use credit for is cash back. Cash back on purchases. Now, this is funny because most people, they do this as like a first reason. They're like, oh, I pay it off every month, but I get free airlines points, or I get this, or I get that. Let me tell you what, 10 years in the financial industry, most people can't manage their income and their paycheck well enough for me to be confident that they're going to pay their credit card every single month down to zero and take advantage of the cashback rewards to the degree that they get more than they're paying in interest. I don't think that happens very often, right? Like, why do you think the banks can give you cash back? Because other people can't pay their bill on time. Why would they incentivize you with 0% interest rates? Because they know you're going to charge your bill up and then not be able to pay it, and they're going to be able to make all their money on the back end. Okay. There are people out there with 30, 50, $100,000 in credit cards that's normal life for them. And the banks make a ton of money off that, right? So I tell people, don't even worry about cash back on purchases yet. Get to phase 4 or get to phase 3 on the blueprint of financial freedom right here. Okay. And then at that point, we've got no consumer debt. We've got our budget down. We're saving 40% of our income. Life's great. We're now financially disciplined, solvent, above water. We're winning. Now we can go get all the cash back. And guess what? If you're in that position, you're probably going to get better cash back rewards anyways, because you're financially solvent and you've got better stats to show the banks, which goes back to this trust and obligation factor, right? You can say, hey, you can trust me a lot more and I can be obligated to a lot more because I don't have other obligations. Okay. So this is the third thing. The fourth thing is to get passive income. Okay. And I'm not talking about even borrowing against the credit cards yet. This is called credit leasing. This is something we do with our sophisticated investors. This is where you lease your authorized user position on your credit card to someone that's building their credit so that your payment history shows up on their report, right? And then they get the benefit of your score. They don't actually get your card. They can't spend your money. They don't even have to know who you are. They just know that, a Bank of America card now reports on their credit and is showing a good history and good payments. And so they get an increased score. They'll pay you monthly for that, right? So that's like your credit card just turned into a rental property and you're making passive income. And guess what? They can't clog your credit card's toilet because it doesn't have one. Okay. They can't call you because they don't have your phone number. Nothing can break because it's a credit card and they're not using it, right? So this is some of the easiest passive income you're going to get. But again, I can't do this if I don't have everything set up correctly. And then finally, we want to get into non-recourse credit. Okay, this is business credit. This is investment credit. This means that it does not go on my personal credit score, right? So this is for business and investing. This is the final thing we would use credit for. Notice none of these were to get a new car, right? None of these were to impress my buddies. None of these were to float the vacation to Disney World because it's been a long winter and the family's tired and the kids need to have fun. Right? None of this is for paying for braces. None of this is even for student loans. None of those are the purposes of credit. Why? Because none of those things gain financial freedom for you. Buying a car on a credit on a credit loan with the bank does not gain financial freedom. Your income is now going out the window. The thing you're going to build financial freedom with you have less of because of the car loan. 30-year mortgage, terrible idea. We've talked about that before. That's not going to help you gain financial freedom. Neither will the 15-year. Right? So all of these things that people use credit for, right? Spending, money on clothing on their credit cards, getting student loans, getting cars, getting mortgages, all of those things lessen your financial freedom. When is the last time you heard the number one reason and the first thing you should get credit for is 6 months of reserves? By the way, you're never going to touch it because you have 6 months of cash reserves before you ever use that. Meaning you have 12 months of reserves. Where would people have been during 2020 when the market crashed and people were losing jobs and there was the whole, I'm a what was it called? A vital worker. It's like, if you didn't have a certain working essential worker, where would people have been if they had 6 months of cash reserves and 6 months of credit on top of that? They would have been fine. Where would people be at right now today if they were facing the ultimatum of get the shot or lose your job? Right? Like you could be like, if that's your thing, great. I'm going to do it. I'm going to stay. Or that's not my thing. I can be unemployed for a year and be totally fine. I'm going to leave now. Right? So that's greater financial freedom because it gives you some breathing room. Okay. Increased cash flow. You can save more money. That gives you more financial freedom. Cash back on purchases. Guys, again, the cash back on purchases, this is coming from usually two areas. Number one is other people that don't pay their bills, right? So they don't pay their cards off, they pay interest. That's who's funding your airline miles. The other thing would be vendor merchant expenses, right? So like if you go to a store and they use credit cards and they use credit card processors, the credit card company typically charges them 3 to 5% of all their transactions, right? And so that's a stream of revenue that the credit card company gets. And so a lot of times when you're getting 1 or 2 or 3% cash back, the credit card company is just splitting you in on those merchant fees. They're refunding it back to you, the consumer. Why would they do that? Because again, they think you're going to spend more, and the more you spend, the higher likelihood you have of not repaying the card, the higher likelihood they have of getting more interest than what they're giving you in cash back. You got to know this stuff, guys. The passive income, credit leasing, you're helping other people build their credit and you're getting easy passive income. Okay. Ryan Ambrosetti says, let's go Brandon in the comments. No comment. I'll tell you guys a story though in a little bit. Non-recourse on this. So this again, business and investing, that gives you more financial freedom. These are all reasons why you would get credit. Okay. So those are the purposes. Now, how does credit work? Right. So let's say that I'm brand new, and I'll share with you guys what happened for me because I wasn't using credit early on. Right. I thought debt was bad. I thought credit was evil. I thought all this stuff about debt and credit. Right. Because I wasn't using it, I then didn't have a good score. Right. So there's two ways you can have a bad credit score. You can have poor or no history, or you can have bad history. Okay. Who remembers being 18 years old, you try and get your first car loan and none of the banks will approve you and your mom or your dad has to co-sign, right? And you're like, why do I have, and they tell you don't have good credit. You don't have a high enough score. And you're like, well, I've never borrowed anything. I've never been late. And they're like, exactly. You have poor or no credit history. Okay. So that's one of the first ways that you have bad credit. The other one is bad history. Right. So again, it goes back to trust. You have to think like the bank. We have to stop thinking like consumers and think like the institutions that get all of our money. Right. If we do that, we can start getting the money instead. We have to think like the bank. The bank is going to look at, okay, if you're brand new with zero track record, the likelihood of me loaning you money, right, is going to be very low because you don't have any proof that you've repaid it. Now, granted, you don't have any proof that you haven't repaid it, but there's also no proof that you have. And so this person would be, poor credit score and bad credit because they've got no history. Secondarily, bad history, right? Like this is the thing about credit that nobody wants to address, right? Like if I have bad credit because I have bad history, it means that I promised to pay money and then didn't, right? Like that's like, there's this culture of like, poor me, I have bad credit, I'm a minority. No, you freaking borrow money from people and don't pay them back. You should have bad credit. Like that's the red flag for everyone to know. Don't lend that person money. They borrowed it from me. They didn't pay me back, or they were late all the time, right? It's not a victim or a poor me or I'm a minority because I have bad credit or, this is socially unjust. No, what's unjust is you promising to pay and then not pay, right? And we're talking outside the realm of like, if you're going through negotiations and debt settlement where you're working with the bank, then that'll obviously ruin your credit as well. But we're saying, a lot of people they'll say, I'm going to borrow money and then they don't repay it. Or they say, I'm going to borrow money. And then they agree that the 15th is the day they're going to make the payment. And then they don't, right? That's going to give you bad credit history. So if I'm trying to build my score, right? And I have a question here is what's an ideal score? If we're looking at score ranges, in my opinion, anything below 700 is not good. Okay, there's no reason why everyone should not be able to build up to a 700 or higher. Okay, typically, if you're looking at 650 to 700 or in that range, right, that's considered like pretty fair, like okay, decent credit, right? So people will say that's fair. If you're like below 650, right, that's kind of like poor credit. And then if you're like below 600, which I've been before, like you have terrible credit. That's just bad credit. Okay. So, and these are all, again, reflective of some indicators that we're going to go over, right? If you're above 700, that's great. I think the highest you can get typically is going to be like 850, right? I think if you're 800 or higher, then if you're in that range, that's going to put you in the top 1% of credit, right? So we talk all the time about being in the top 1%. You would want to get to the top 1% of credit at some point. Because again, that means that you have good trust. You've got a good track record. You've got good history, right? So for me starting out, I was building from ground zero. I didn't have good credit because I didn't have credit because I didn't borrow, right? Now this all, for me, it went all the way up to the last couple of years because I was, again, like, if I think back, I was doing Dave Ramsey like midway through 2016, like gung ho until I started learning about, the Federal Reserve banking system and all the stuff that I talk about. I was a Dave Ramsey guy and I thought credit was bad. And I paid for my cars in cash. Like there was a point where Jerry Fetta paid cars in cash and paid off car loans, right? I would murder myself if I saw myself today doing that. But at one time I thought that was a good idea. So I had bad credit because I didn't use credit. I had no history. I had no payments. I had no open lines. Okay. So when I started thinking about credit and learning that I needed to have credit and it was necessary for building wealth for all of these reasons we just mentioned here, I then had to look at, okay, how do I build my credit? But how do I do it in a way where I'm not taking out mortgages and I'm not taking out car loans and I'm not charging up credit card balances and borrowing money where I'm going to pay interest that doesn't pay for itself just for the sake of having a good credit score. Because that's what most people do. They're like, oh, I have a good credit score. Well, for the average person, that means you've paid a buttload of interest. That's all that means, right? So then I had to look at, how do I get a good credit score without falling into any of the traps? Phase 2 of the blueprint to financial freedom, we talk about getting out of the financial traps. Don't get a car loan. Don't get a traditional mortgage, right? Don't have credit cards. We paid all that stuff off already. Student loans, we got rid of that already. We're never going back to that. So I was looking at, okay, how do I do all this without getting back into those systems? Okay, because when I'm building credit, there's a couple of things that are taken into account. So the first one is going to be number of open lines. Open meaning that they're live. I can borrow against them. I'm actively, either it's available or I'm paying on it, or it's a loan that's currently being, in force. It's in service, right? So number of open lines. The more open lines I have, the higher my credit score is. Now, again, credit score is a complete arbitrary, meaning it's made up. It's a random number based on a point system that was made up, but it's really based on your credit report. So the score is like the after effect. If I have a good, healthy credit report, my score is going to be great. Okay, I didn't know that. I thought the score was like this magical number, and I was like the FICO score, the experience score, all this stuff. And I didn't realize that the score was based on the report. The report was based on what's on the report, which is largely based on, my behavior, the loans that I have, some of the things we're going to talk about. So if I'm trying to increase my score, I have to build a good credit profile, a good credit report. Okay, so how do I go about building that? Again, lots of open credit lines. Okay, so that's one. The second one is variety of credit lines. Meaning if I have, some revolving credit lines, which would be like a credit card, right? That's one. If I have some term loans, meaning it's like an agreed upon term and I'm paying it every month, that would be a type of line, right? If I have some fixed loans, variable loans, auto loans, mortgages, like the more types of debt that I have, the better that looks on my credit profile because it diversifies my credit. So when I go to a bank or I go and I look at, any kind of loan, they're going to look at, okay, there's a large mix of types of debt. This person has a number of those. And then the third thing is on-time payments. Okay, so if I have on-time payments, this is going to help me build my credit score. Right? So I want to have a number of lines. I want to have a variety, a diversity of different types of debt. Okay. Now, what do I do if I'm trying not to borrow, if I'm trying not to use, car loans, right? So I can get, what up, Samson? I can get 0% credit lines. I can make sure I pay my credit cards off every month. That's easy. Those are like my revolving lines. So I do that. I get those. I pay them off every month. I never pay interest. Okay. What about term loans? Because I'm not going to get a car loan. I'm not going to get a student loan. I'm not going to get, a personal loan. Okay. So you can use credit building loans. These are things like self-lender, Credit Strong, where I might borrow, quote unquote, money based on a down payment. I might give them $500. They're then taking my money and they're loaning it back to me, and I'm going to pay interest, or I'm going to pay a payment on that. And then usually they have it held in a CD. So the interest usually washes out. Okay. So I'm just basically showing a payment history, and that's typically going to help me, right? So if I have 2 or 3 of those, that gives me now fixed loans, term loans, right? What else can I do? I can report my rent. If I'm a renter, I can actually report my rent to the credit bureaus. I can show them, hey, I've got up to 2 years of positive rent payments. I've been on time. That's now going to report on my credit. It's going to be another on-time payment. If I have a mortgage, that's automatically reporting, right? So there's a number of ways that I can build credit and have these good items on my report without going out there and getting a car loan and a mortgage and a student loan and a this loan and a that loan and being a consumer and paying interest. Okay. So on-time payments. The other one here is payment length. Okay. The actual history of the credit line itself, right? So if I have like lots of credit cards, that's great. Lots of different loans, that's great. So I have the number, I have the variety, I've been on time, but let's say I've only had them for 1 year, right? Like, who are you going to go with? The guy that's got 5 years of good credit history and all of these other factors, or the guy that's got 1 year of good credit history? You're going to go with the guy with 5 years because you're like, that's a longer track record. I can look at that and see that that person's been on time and they're good to borrow. They're good to loan money to, right? So payment length or history is another one. This is where the credit leasing comes in, right? So if there's a young person that doesn't have large credit history and they're like, I've got a lot of lines, I've got a variety, I've been on time, but my credit score is still not where I want it to be. That's where they can go to a Justin Goff, who's, established. they've got a certain amount of credit length, and Justin can then rent his credit line to them and say, hey, you can be my authorized user. You're going to pay me $200 a month. And my 10 years of good payment history is now going to show up on your report. Boom, like magic, score shoots up, right? So that's what that does, okay? So we have number of open lines, variety of lines, on-time payments, payment length, and history, okay? The other one is going to be the utilization ratio. Okay, this means that I'm using a certain percentage of my debt. I want this typically to be less than 30%. Okay, less than 10 is even better. But this would mean if I had a $10,000 available credit line, I have less than $3,000 on that card balance, right? Or if I've got 100,000, I've got less than 30,000 on that card balance. The higher the utilization rate, okay, the lower my credit's going to be. Why would that be? Why would that matter? Because if I go to Nano and Nano's my bank and I'm like, Nano, can I borrow money? And Nano's like, sure. How much do you need? And I'm like, well, I need 20,000. He's like, great. Who else do you owe? And I'm like, everyone. Nano's not going to give me that loan. He's going to be like, dude, you need to pay those people back first because I'm not going to be next in line for you to have late payments on. Okay. And then the sixth one that we look at is inquiries. These ones are really, I think, overhyped. They don't do that much for your score, right? So like if you do a car loan and you go shopping and they start, checking in with all the banks and hitting you with inquiries, one inquiry might reduce your credit score like 2 or 3 points. Not awesome, right? Like it's not like it's great to get an inquiry, but it's not like it's the thing that's killing your credit score. A lot of people are like, oh, it's my inquiries. No, bro. It's the fact that you have late payments and you've got your cards maxed out. Okay. And then obviously like things like defaults. Okay. Those are going to be things that can impact your score. So we want to have none of these at all. Like, and if we want to repair them. We also want to make sure that we are keeping lines open. Keeping open lines. When you close a line, keeping open lines. I can't spell and talk tonight. So when you close a credit line down, who's ever done this? You pay off a card and you're like, that card was Satan himself. I'm cutting it up and closing it. Awesome. You just reduced your credit score. Why? Because you reduced the number of open lines, right? Never close a line. Even if you're never going to use it again, leave it open because it gives you, again, what? A number of open lines, variety of credit, on-time payment history, as long as you've been on time. And then it's giving you payment like reporting history. You want the reporting history. If you have a credit card that's freaking 30 years old and you got it in the 1987 and you're like, man, I've never once used this thing. Great. Keep it open because that's probably your number one length history reporting line. And also if you lease that out to someone, you're probably going to get like $300 or $400 a month for it. Right? Like that's not bad. Like you pay the annual fees, $50, whatever it is, suck it up and then keep that card. Right? So these are all things that would affect your credit. And there are more, but these are the main ones. Okay. Now, the way that a credit report works, right, is you have the credit bureaus and they have these very fancy titles. Bureau. You think it's like a government agency. They're not. Like everything, it's a private corporation, right? So you look at Equifax, TransUnion, Experian. Those are not government agencies. They're private corporations. They're for-profit companies. What they do is they furnish data from all your lenders. Meaning they'll go to your banks and they'll say, hey, what is all of the loans that Jerry Fetta has ever had with you? And the banks will tell them, and then, they'll put it on the credit report and they'll say, has Jerry been on time? Has Jerry this? Has Jerry that? Everything on your credit report is based on the data that the banks are providing to the bureaus, right? Which means it's based on whether the data was true, the record keeping and the accuracy of the banks, right? And whether it's accurate or not, if the bank says it's there, the bureaus are going to put it there, whether it's true or not, right? So when we're looking at this, there's 2 ways to build credit. We can, 1, remove bad things, right? This is like second grade. Or 2, we can add good things. Those are the only 2 ways to build your credit. Okay. So the one that most people look at is removing bad things, right? Credit repair. I want to go through and I don't want to do credit repair and disputes. And we offer this on phase 0. Okay. But credit repair is not magic, right? So I think the statistic is 30% of credit scores contain inaccuracies. I think I misspelled inaccuracies, but I'm a money guy, not a grammar guy. So 30% of them contain inaccuracies factually, like the credit bureaus admit that 30% of our scores and reports are inaccurate, meaning there's information on there that shouldn't be there, or there's information that should be there that isn't. Okay. What that means is we can dispute them. We can say, hey, I want you to prove to me the accuracy of this late payment, right? And 30% of the time it will factually be inaccurate. When it's inaccurate, the bureaus have to remove it from the report. Okay. So that's the first step, which again, it's not magic. That means 3 out of 10 swings, we're going to get something removed based on the fact that it's inaccurate. Okay. The other stuff is going to be untimely responses. And bad record keeping. Okay. So I want you to think about, again, from the standpoint of the bank. You're the bank, you have thousands and thousands of customers, and you already know 30% of the time it's inaccurate. There's stuff on the report that shouldn't be there, or there's things that should be there that aren't reporting. Okay. So you already know that number's there. Now, if I'm the owner of the bank, or I'm the manager of the bank, or whatever it might be, and I'm the executive, like I have this vision for how my bank should be run. Employees should always call back on time. Everything should be perfect. Our records should be compliant. Everything should be great. The likelihood is you have a $15 an hour checkout worker working at the station, and they don't care about any of that stuff. So when a call comes in or an inquiry comes in, they're getting paid $15 an hour. If they get to it, they get to it. If they don't really care. They're going to go home and clock out. Okay. So when we send these dispute letters, number one, we say, prove the data is accurate. If they can't, which 30% of the time they can't, we remove it. Number two, if they don't get back to us on time, which typically I think they have like 30 or 45 days to be exact to get back to us on an inquiry. If they don't, the federal law says they have to remove the item, whether it was accurate or not, because they didn't get back to us on time. Okay. So, and right now during COVID, this one is not being enforced, right? The credit bureaus are heavily riding on this. Nobody's enforcing because they're like, we're understaffed. Everyone is understaffed. Okay. So the credit, the regulators are not really enforcing the timely response thing. But think about it like this, and Nano will understand this being in sales. You win through follow-up, right? So on the first letter, they send a timely response. That's awesome. Let's send another one. Great. Let's send another one. Let's send another one. Eventually they're going to trip up. So that's what we do is we over time wear them down. It might take 6 months, 9 months, 12 months, whatever it might be. And boom, 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 boom. Eventually they're going to slip up because it's an outsourced worker in India who has no concept of what it's like to be in the US and timeframes and whatever, or it's a $15 an hour worker, that just does data entry and answers the mail or whatever it might be. And so we're riding on people being people. Mistakes are going to happen. People are going to mess up. When they do, we're going to capitalize on the untimely responses. So again, this is one during COVID, they gave leniency to the credit bureaus. They said, we understand you're understaffed. We're not going to hard enforce this law. Okay. Now, patience is wearing thin because we've been 18, 24 months into this thing. And it's like, all right, cool. Like, how long are you going to use the COVID excuse? So eventually that will be enforced again. The other one is bad record keeping, right? Like we say, prove this debt's valid. And it was valid and you did borrow it, but somebody lost the file. And because they lost the file, they can't prove it's valid, even though you and I both know it is. Okay. So again, we're relying on the fact that people are going to mess up. And so when they can't provide or furnish the file, it's going to get taken off. Right. I looked at a report we worked on with a client yesterday, removed 6 items off his credit. All of them were valid. He borrowed the money and did not pay it on time. Like straight up, like that's all it was. He knew it. We knew it. He's like, hey, are we actually legally allowed to dispute this? And we're like, just throw the line out and see what happens. So we send the disputes out, and sure enough, the banks did not keep the records. Because they did not keep the record, they can't legally report any of the information to the bureaus. They have to take the data off of the report. Okay. So these are the 3 ways that we take bad things off a credit report. Everyone gets stuck and fixated on this because it's exciting. You have like, you're fighting back, right? You don't like the bank. I don't like the bank. And this is the way that we can stick it to the bank by using the rules against them. That feels awesome. Right. But no different than like when you're trying to get in shape. What helps more, diet or exercise? Diet, right? You can exercise all day long, but if your diet sucks, it's always going to be harder. You can diet and barely ever exercise. You're typically going to be in better shape, right? With finance, what do we say? What helps more, income or expenses? Income, right? Expenses, like you can budget till you're homeless. You're not going to build wealth that way. So with credit, what helps more, getting rid of bad things or adding more good things? adding more good things. There's only a certain amount of bad things we're going to be able to get rid of. 30% of them are factually inaccurate. If there's untimely responses and bad record keeping, we'll get rid of the other ones. There are some of them where they're going to be accurate. The Bureau will respond on time and the records will be there, and you will not be able to get the item off your report. So if our only move to build credit is repair, credit repair, credit repair. And it's almost this thing where someone in my position or some of my clients that are watching are like, I don't need credit repair. I don't have late payments. I don't have this. Okay. And that's true. If you need credit repair, it's because you do have late payments. You do have things that shouldn't have happened, irresponsibilities, bad timing. Only 30% of the time is it ever someone else's fault, which means 70% of the time where there's a negative mark on credit, it is your fault, right? So we're saying we're going to try and remove those, but we can only do so much there. The real strategy is add good things. Okay. So again, this is where we add things like self-lender, credit building accounts, credit strong, like those are not real loans, meaning you're not going to a suppressive institution and saying, loan me money, right? You're going to someone that their goal is to help you build up your credit. And they're like, hey, we set up this system that if you use it, you don't have to pay interest to the banks and get involved with debt, but you can actually have a credit score, right? So that's, again, credit building loans. This would be a good thing you can add. Whether you're broke or whether you got a $5 million net worth, this is going to build your credit, right? So credit building loans, right? Secured cards. These are another one. Secured credit cards. This is another one anyone can do at any stage, right? If you're a renter, you should be rent reporting. You can also report utilities. You can report subscriptions. Again, this is whether you have bad credit or good credit. This is all stuff you can be doing to give yourself a leg up. Reporting subscriptions. If you've got Netflix, that's a payment. That's a monthly payment that can be reported, and that can build your credit. Subscriptions, we said that already. What else can we report? We can report actual credit lines, right? So we can go through funding processes and we can get you lots of credit cards, funding 0%. This is all going to give you, like, I think the last funding round I did, I think I got like 9 new cards, right? So I now have 9 positive lines reporting on my credit from those cards. I'm paying them every month. I pay them off. Some of them I don't even charge, right? But they're there and they're reporting. Now, the beauty is if I have 9 of these lines, once these are seasoned, I can then rent these out. These are 9 sources of passive income, right? Think about that. I didn't have to get an FHA loan on a fourplex to get the $500 a month passive income. No. I got a credit card. I got 2 of them. I loaned it out to 2 dinguses that are trying to build their credit up. They're going to pay me some money every month. And I now have the passive income of owning a fourplex. Which one would you rather own? Nano? I would rather have the credit card because they're not going to call me in the middle of the night and be like, I clogged my toilet because I had too much Taco Bell last night. Right? So these are all things anyone can do to build their credit. Everyone should be doing these things. Right. Now, here's the beauty of it is some of it you're going to do anyways. You're going to have a mortgage or a home equity line of credit anyways. That's building your credit, right? You may have business loans that you had to personally guarantee. That's going to build your credit. And so as long as you keep these in and then you follow at the very beginning, we talked about these different things, having, your on-time payments, making sure that all this stuff, these first 8 points here are being taken care of. You're good. Like you're going to be able to build your credit over time. And so the longer you do the right things, the longer it's reporting to your credit, the better your credit score is going to be, right? If you mess up, boom, let's dispute it. Let's try and get it taken off. Maybe we can, maybe we can't. We have to give it a shot, but it's really about, okay, adding good things, getting the funding, doing all the right stuff, because again, we're trying to achieve these 5 outcomes with our credit. Okay. So guys, I hope that gives you a different spin on credit. There's again, a lot on this topic. There's a lot of like special, like bro science and like some of the things that I want to make sure you guys never get involved in, right? So if you're in the position of needing credit repair, never do something called a credit sweep. So if you hear something called someone advertising something called a credit sweep, run the other direction. They're actually practicing a fraudulent activity where they've somehow figured out how to furnish data to the bureaus, and they're going in and manually removing things from your report without actually disputing them, which is illegal, right? So that's one you never want to do. Buying trade lines, like if someone says, hey, I can get you added to a car payment or a mortgage, that's also super illegal, right? Different than an authorized user piggyback or credit card line. Like that's open, you can do that. But if someone's like, the whole trade line, like I'm going to get you a 60-month season car loan. They're committing fraud, right? Usually if they're advertising that they're a law firm, they're not. Like Lexington Law is not actually a law firm, right? Like you have to watch out for these buzzwords because again, 70 to 80% of people are financially illiterate. I would venture to say 95 of them are financially illiterate when it comes to the topic of credit. So a lot of these banks, a lot of these credit repair agencies, a lot of these guys that make money in the industry, they're not good people, right? And I want to end on this note before we wrap up for questions. I had a guy tell me, and this is something I've always thought of, and I think it makes a lot of sense. It's okay to do business with the devil as long as you know it's the devil, right? When you are using credit, I want you to think about who's on the other line to that line, who's on the other end of that line, right? It's not grandma, right? It's freaking JP Morgan. It's Bank of America. It's Merrill Lynch. It's all of these institutions that make money by treating you like a prey. They're predatory. Right. And it's funny because, when you try and get credit, what are they looking at? They want to know what's your trustworthy level. Show me your score. Show me your report. I need to know that you're trustworthy. Well, we already know they're not. Right. You can just go on Google News and type in bank fraud and you'll just see boom, 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 article after article, which are probably all very recent because that's what these institutions do. They commit fraud. So we already know they're not trustworthy. We already know they have no skin in the game. Right. So we're backing it by our trust and our obligation. They have no trust. They don't even have the obligation because if we default, guess what? All of their loans are insured. They're going to be fine anyways, which means they're destroying your credit report for sport. They're taking away your house for sport. They don't need it. They already got paid. They're taking it because they can and because they're big enough to. Right. So this is one of the reasons why I don't get involved in like consumer finance and all this stuff. I don't want those people on my line. I don't ever want to be obligated to a multi-billion-dollar institution that's proved to be unethical. By the way, if they're federally chartered, they're a shareholder in the Federal Reserve Bank. Think about that. That's like, if you understand the Federal Reserve Bank, that should hit you like a ton of bricks. That's a shareholder of theirs. It's a partner of the Federal Reserve Bank, the most suppressive institution in the country. And you're cutesy over there, like, I'm going to go get a mortgage from them. It's going to be so great. No, they're going to suck the life out of you for sport because that's what they do. They're suppressive groups, right? So I need to know that about them. I need to fully confront that. There's a reason why I was so direct with that just now. You need to fully confront that's who I'm dealing with. That's who's on the other end of this line. That's what they're capable of. That's what they'll do. And they'll do it for sport. And so I need to understand that. And it's okay for me to then do business with them, knowing that that's the case. When it's not okay to do business with them is when I try and act like that's not it. Oh, they're not that bad. I know Sally at the front desk, like for 15 years, our kids go to school together. Guys, Sally's not the one in the boardroom. She's the nice lady that works at the front desk. She's not the one in the boardroom that's like, yeah, it's fine that we're going to pay $10 billion in fines. Just add it to our cost of goods sold and do it anyways. Right. So that's what I want to wrap up with on the note. We have a lot of good questions. Again, if you guys have questions, what I'd like to do is I would like to open this up for questions. We have a lot of good questions I can see on Facebook already, on Zoom. Drop them on Zoom and I'll answer them live here. Same thing with Facebook. We won't be able to go live, but I can read. So I'll use my reading skills and we'll go over those. Good to see everyone. By the way, if this helped you, I want you to share it. This is, again, probably information that the average person is never going to come across for good reason, is the banks doing it don't want them to know about it. So make sure you do share this if you get a chance. And get the book too. Grab the Blueprint to Financial Freedom book. All right, Justin, good to see you. Steve, good to see you. Steve is in Kentucky. I've always wanted to visit Kentucky. That's on my bucket list for sure. Brad, good to see you. Jessica, good to see you. Justin says, note to self, never borrow $20 from Jerry. I like my big toe. Fair enough. Ryan says, sounds like DeSantis is beginning to you. We live in a good state with a good governor. Let's go. So I have a story for you guys. Again, I don't get political at all. This is just a really funny story, whether you like the guy or not. So I was in New Jersey last week visiting some friends. And we're just sitting at the table eating, right? And like the whole let's go Brandon, and it's been all over the news and social media. Like you have to live under a rock to not know that that's a chant, right? So we're sitting there eating breakfast and they have a little girl who literally just turned 3. Like the day we got there was her 3rd birthday, right? So she's just innocently eating her breakfast and we're sitting there and out of nowhere, We're in this tiny little quiet diner on a Sunday morning eating. She starts chanting, "Let's go, Brandon." And she starts yelling it as loud as she can in the diner. And she has no idea what it means or that it might be offensive or any of that stuff. And we can't get her to stop. She just keeps going. And you know how 3-year-olds are. The more you tell them to stop, the more they do it. Right. And so she's just yelling this for probably 5 minutes, like, "Let's go, Brandon." And I die. Like I said, I'm not going to get political with it at all, but I think all of us can laugh at that. It was just a hilarious moment. And that reminded me of that with Ryan's comment there. Okay, Justin asks, what is the ideal credit score for the authorized user trade line? So credit score ideal is going to be at least 700, right? You typically, that says 7,000. That's not a real score. So at least a 700 score, you typically want to have lines that have at least like $5,000 balance, like open credit, no late payments, perfect history. And if you can have like the longer, the better, but if you can have like at least a 5-year history, like where the line's been open for 5 years, that's like really optimal. But if you do this, you can be making, you know, like on a $5,000 line, you might be able to make like $300, maybe $400 a month. Right? If you go direct and find an investor or someone that needs that, right? I shouldn't say investor, it's more of a consumer that needs the credit repair. The higher the score, the bigger the line, the longer the track record, the more you can command for that line. Not to say like, if you have a less than 700 score, don't even try. If you have late payments on the card, don't even do it, right? If you have a few thousand, you might only make 50 or $100, which is better than nothing. Same thing if it's like a year old or 2 years old, you're not going to get a ton for it, but it is going to be something that does, you know, produce some kind of income, right? So those are kind of the things to look at with the authorized user trade lines. Good question. Andrew has a question. He says, if I pay off a car loan with a Sacred account and then paying my Sacred account back, that car loan is considered closed then, correct? Is that going to negatively affect my credit report and score? So that's the first question. So yes, if you pay off a car loan, it will negatively affect the score because you're closing a line down. So what I recommend doing is on a car loan, pay off everything but like maybe $100, right? And then you can make payments on it or whatever you want to do on that $100, because you can just prepay. You can be like, hey, I want to prepay X months worth of payments and then just leave the final payments, you know, to the end of the term. And that way that line stays there and it stays open. At some point, you're going to pay it off and it will close down. The other thing too, is if you don't want to worry about it, which is what I did, I didn't want to keep the car loan. Again, I don't want the banks on my line at all. So I shut down that line, but then I immediately opened up a credit strong loan, right? So a credit building term loan. And so I replaced the line. And so it went down because I closed it, but then it started going up again because I opened another one up. So that's a good way to mitigate that. Andrew also asked if I'm in the Credit DynamX program, would it be a good idea to pay off my car loan with my Sacred account if it is going to negatively affect my score? I think we answered that. You could, and then I would just replace it, right? So if you wanted to pay the entire thing off, just replace it with like Credit Strong or Self-Lender. Or like I said, prepay all of the months to like the final month and then leave, you know, a couple $100 or $1,000 on the loan so that it's still open for the rest of the term. Todd asks, if available credit on a card is consistently less than 10 to 30% and they send you offers to increase the line, does it do anything or does it reach a certain point that doesn't help anymore? Say a 3 to 5% utilization. Todd, that's a great question. Increase the line if you can, right? Anytime you can increase the line, that gives you, again, more open. Right, let me find my points again. Yeah, so that's, again, it's a bigger line. So you have open lines, you're increasing the size of that. So that's going to give you an even better utilization, especially if you're going for funding, right? Like the lower the utilization, the better. So anytime you get an offer to increase the line, it's fine too. It's a good idea. You will typically get an inquiry, but again, that's going to reduce you by like maybe 3 points. And then it'll go away usually after about 6 months, it no longer impacts you. You can dispute inquiries if you want to. Todd asked a good question. Do Sacred account loans report to the bureaus? No, they don't. And that's actually something I'm working on. I think that in the future, we'll probably be able to work with some of our carriers to get them to. And I think that that's fair. I think, you know, if you're borrowing from the, you know, Guardian or Mass Mutual and New York Life or whoever against your cash value, that technically is a loan. Sure, it's off the books. It's not going to go on your credit, but it could. And so I think that that would be great if the, you know, the insurance companies would, you know, furnish the data to the credit bureaus. So that's something, down the road, I hope that they do that, because that would be a great way for someone to, build solvency and credit, because it's not a loan, like you're paying it back to your own account technically, but it is a loan because it's from the insurance company. So good question, good thought. Jessica asks, what's a smart way for my 19-year-old son to purchase his first car? I've encouraged him to get a sacred account, but what would be another option? If he's not going to get a sacred account, get a beater with a heater and just pay cash. I wouldn't do a car loan. I don't love that option. Again, like the beater with the heater option, pay $2,000 with cash. Like, you're never going to see the future value or growth of that cash again. So if he's willing to listen to, some of our content, set up a call, do an account, that's the better way to go about it. In lieu of that, just get something cheap with cash. What I do like about cash is even though it's not ideal from a future value and growth standpoint, it does force you to stay within a budget on a car, right? Like, how many times we've all done it. We go into the dealership and we're like, I'm not spending more than X number. And they always talk you up every single time. If you go in there with cash, it's like, it's not even about the payment. It's the fact that I only have $5,000 in my pocket and I'm willing to spend the entire thing on the right car, but there's no way for them to wiggle you up. Right. And so I think if people did pay cash for vehicles, even though the sacred account's better, even though self-financing is better, I think a lot of people would be in a better financial position, just because they wouldn't be committing to like a $60,000 loan, because they're like, oh, I can afford $1,000, right? Like, sure, but you're taking that away from other areas. Ryan says, if you use credit utilization, does that affect your available balance for that individual card? Let me reread that. If you use credit utilization, does that affect your available balance for that individual card? So I think Ryan's asking, if you use a card, if you charge up the balance, does it affect the available balance? Yes, it does. So if I have a $10,000 card and I then charge $3,000, right? My balance is 3. My open line, my limit is still 10, right? But it now shows utilization is higher, and so my score is going to drop because of that. Versus if I pay it down to like $500 or I pay it off entirely, that's going to be a lower utilization rate. Still an open line, still a $10,000 limit, but I've got a lot more left over. Jessica says, would you say the sacred account would be best? I think it would be, as long as he understands it and he's educated and learning about it, it's best. So I would definitely have that conversation with them. Excellent questions. All right, let's go into our Zoom questions here. So again, if we're on Zoom, we will go live. Don't be shy. I would say that I don't bite, but I can't promise that. But we're on a microphone, so I can't get to you. Okay, good. So let me jump on to a couple of our Zoom questions. We'll answer these live. Oh, I had one here. Mark says, I love that you acknowledge your dog, even though you have an audience. That shows me you're a kind-hearted person. That's true. And also, if I didn't, he would be antagonistic and loud. So Samson forces you to acknowledge him. But I do love my dog. Okay, Tamara has a question, but let me bring Tamara on live here. I just muted her on accident. All right, we're live with Tamara. How are you tonight, Tamara?
Wonderful, wonderful. How are you guys doing?
We're doing good. What is your question?
Well, sir, I was wondering about the whole credit validation program. My concern was mainly the taxation risk. If you're, let's say, if you have a debt of 50 grand and you get in the program, you are settled at, let's say, 45%. So what if the remaining, if the validation program goes through, you are forgiven for that extra, whatever amount you are forgiven, the 50 grand, would that be taxable? Would you get a 1099-C or 1099, whatever form?
That's a good question. So Tamara is saying if you're in like a credit like negotiation program. So specifically, the one that Tamara is mentioning is called debt validation. Debt validation is very similar to credit repair, actually, except we're going directly after the bank, right? So the bank is not allowed to collect money on a loan that they did not compliantly record keep and like do all the documentation for. So we have a program called debt validation where the law firm we've partnered with, they send dispute letters to the banks on the actual debt. So they say, we call bullshit that car loan is real, even though it's a real car loan. if the banks show, then they request all of the data. They're like, we want to see all of the information, all of the records, all of the files you've kept on this loan. And the banks have to report it because of the consumer protection law. So when they report it, if our law firm finds that any of it's inaccurate, the debt now becomes invalid and the bank has to forgive the entire amount. Now, when that happens, typically that's not taxable. And the reason why is the bank broke the law. So it's not like they're forgiving it. It's the debt's being confiscated. We're saying it's actually fraudulent for you to collect on this debt because it's not a valid debt. So we've invalidated the debt in that case. So that's called debt validation. Now, the one that is typically taxable is called debt settlement, which is us going to the bank and saying, hey, we just can't pay. And so we want to negotiate a smaller amount with you. We know the debt's valid. We're not questioning that. We just want to settle. So if the bank settles, they're typically going to settle for, maybe, 30, 40, 50, 60% of what was owed. And then they're typically going to do a loss on their taxes for the remainder, which is what Tamara was saying. If you settle for 45%, the reciprocal 55% is a write-off for the bank. They get to write it off on their taxes as a loss. Now, when they do that, they then would send you a 1099. They'd say, hey, we wrote this off as a loss, which means you received it as income because we forgave it. And so you'd have to pay taxes on that 55%. There is a way out of that. If you file paperwork with the IRS to prove that you're in a financial hardship, they will forego like the tax part of it. But again, that's typically with debt negotiation, debt settlement, not necessarily with debt validation, because validation, it's invalid. It's not legal for them to actually collect on, which we prefer validation over settlement and negotiation anyways. DF has a comment, not necessarily a question. He says, I did exactly that. I didn't utilize credit for over 30 years and now paying the price for not doing so. Yeah. And DF is right, guys. The one that he just mentioned, not using it in the moment, you feel like you're winning, right? Because you're like, I'm different. I don't have debt. I'm not using credit. Those people are all dumb. Dave Ramsey would be proud of me. Then you need the credit, or you're trying to get a certain credit score like I am, right? I should be at an 850 because I've had 10 years of doing this. But because, the first half of my career, I thought debt was bad. And then residually, even though I started learning about the Federal Reserve and taxes and all this stuff that I talk about in passive income, I still thought credit was something I didn't need for a couple of years, right? So it wasn't until a few years ago where I realized, oh, that's dumb. I do need credit. I do need to learn about it. It's important. And then I started having to build it. And again, building it through the way I talked about tonight, it's very different than having a car loan and a mortgage. So what DF is saying is it's hard to build, but it is doable. It looks like DF has a question. Let me go ahead and bring DF on live. All right, we're live with DF tonight. How are you tonight, DF?
I'm doing well, Jerry. How you doing?
I'm good. Thanks for asking. What is your question? Something about Uber versus leasing?
Yes, I noticed that in my area in DC that you can actually lease an Uber. So I'm trying to figure out, is that a way around the debt of getting credit for a car?
That's a very good question. So I actually do that. I don't lease through Uber, but I don't own a car right now. And the reason why is I just don't need one. I live in Tampa. Everything's very close. So me and Lexi, we Uber and Lyft everywhere. In a very close city, like if you're in like a metropolitan area where it's 5-10 minutes to get everywhere, I think Uber is perfect. Sure, it might be 10, 15, 20 bucks a ride. We had one last weekend where it was like 60 bucks for the ride. But when I count up all the money I spend on Uber and I compare it against, what I would have to spend to buy a car right now, or even a car payment or a lease payment, like DF mentioned, Uber comes out cheaper. Not only that, if you're busy, it's very nice being able to sit in the back seat and work and make phone calls and be on my laptop or my phone getting stuff done while someone else drives me around, right? So for me, even if the car payment was cheaper, I have to look at, well, how much would it cost for me to hire a driver? Because that's the real reason I like Uber, is I have a driver. And for me, I would probably have to spend, $15 an hour minimum, probably more than that, because that's minimum wage now. And it would be just expensive and it wouldn't make sense to do. So to answer DF's question, I think if it comes out cheaper, and you want to look at cheaper being what's the cost of, leasing or financing as the alternative, what's the cost of the insurance, what's the cost of the gas, the repairs, the maintenance. In Alaska, we have to buy studded snow tires. I would add that in, and I would divide that over the amount of time I own a car for. And if on a month-to-month basis, Uber comes out cheaper, I'm going Uber all the way. right? So again, that's more if you're in the metropolitan area. I've got some clients that they live out in, in the sticks or in the country or in the fields and stuff, and that's not something that would work for them. Tamara's follow-up question, but debt negotiation would be a fallback in case the bank cannot invalidate the debt, correct? So yeah, back to Tamara's question. So on the invalidation, if the debt cannot be invalidated in an invalidation program, then settlement would be the next option. That's correct. So in settlement, then again, that typically would be taxable. Generally speaking, though, the taxes you're going to pay is cheaper than what the interest and principal on the debt would have been. So there will be taxes. Taxes are something we can plan for. We can reduce taxes. With interest, we can't, right? If you owe interest, you just owe it. If they send you a 1099 and they say this is taxable, awesome. Let's take that amount of money and throw it into a number of different places that are going to completely get rid of the taxable income. So that is kind of what that would look like on a negotiation standpoint. Okay, we have a question from Ken here. Let me bring Ken on live. All right, we're live with Ken tonight. How are you tonight, Ken?
I'm doing fine, Jerry. Thank you for having this. This was a real eye-opener about credit leasing. Honestly, you really don't learn about credit leasing on the finance side. So this is great.
That's awesome. What is your question?
Sorry, my question is kind of long, but it's dealing with on the sacred account. Seems like it's an indexed universal life policy because you're talking about having a cash value along with it, and you can pull the money out. But how are you able to do that and avoid what's called modified endowment contract and things like that, where you're taxed at a taxable income in addition to a penalty? So if you can go into that, that's great.
Yeah, good question. So a little bit off the beaten trail of credit. So to answer your first question, Ken, it's actually not a universal life policy. It's a dividend paying whole life insurance policy. We don't do universal life. The reason being is the underlying life insurance in the universal life contract is annually renewable term, which means every single year your underlying costs go up. Those costs typically get borrowed out of your cash value, which means your policy is now cannibalizing itself, and over time it will end up lapsing. So we don't do universal life at all. It's again high early cash value, dividend paying whole life insurance. Now to answer your question about the MEC or the 7-pay test. So we design it to where we walk right up to the MEC line and then we take one step backwards. And so all the policies are designed to where they're almost a MEC, but not quite. And so they're never taxable because of that. Now, we won't cover all of this tonight. We have other courses on that. Nano, could you connect with Ken Farm? Ken, Nano is going to send you a DM and he can give you a couple of articles, videos. If you want to set up a call with him, he can do that as well. And that'll give you more time offline to go learn more about that. Okay, we have a question from Mark. Let me bring Mark on as well. All right, we're live with Mark. How are you today, Mark?
Great, Jerry. Great show as usual. Yeah, I wanted to ask if a PLOC, a personal line of credit, carries more weight as far as the credit bureau's reporting than open line of credit with a credit card company.
Yeah, that's a good question. Typically, you typically will get more, like, I would say, positive gain from like a personal line of credit or a personal loan. The reason being is they're usually harder to qualify for, right? So if you have that on there, that's something that the bank's going to look at and be like, okay, he has a personal line of credit or a personal loan. From a reporting standpoint, as long as you're on time with both of them, they ultimately will help you. And I would try and have both of them. So there's no reason why you can't have, both or just one and not the other. Ultimately, if you have your credit cards, great. If you can get a personal line of credit, that's also great. And then make sure that you pay on time and you're doing all of the right things to keep those up to speed. Good. I think we have a couple more questions on Facebook. Let me jump into those really quick before we wrap up tonight. Very good questions with everyone tonight. Okay, Andrew has another question. Andrew asks, with the HELOC, you've mentioned using credit cards to pay your monthly expenses and then pay the card off from the HELOC once a month before the card statement date. Is charging up the credit card during the month like that bad for your credit, even though you pay it off before the card statement date, as that shows a higher utilization rate, or does not matter since you pay the card off before the statement date each month? Yeah, so as long as you pay it off, very good question. As long as you pay it off before the statement close date, then that balance will never get reported to the credit bureaus. Right. So the statement close date, like you have your billing date, which is when your payment is due. You have your statement close date, which is more of an accounting date when the bank is saying, hey, everything prior to this date is what we're reporting to the bureaus right now. So as long as you pay it off before that statement close date, boom, it's down to zero. You could have had it racked up all the way the entire month. And if you paid it off before that statement close date, the bureau is never going to see it was charged. And that's basically what you would do every time. And that statement close date typically is based on your billing date. So if you ever want to change the statement close date, you just change the billing date. And usually that statement close date is going to be a couple of days beforehand. So with a HELOC, you would be like, okay, great. I want my billing date to be the 28th of every month, right? So, every month on the 28th is when my bill is due, which means my statement close date might be on the 25th or 26th or 27th. And as long as I pay everything off before the statement close date, then it won't show up on my bill. And on the 28th, none of it will get shown to the bureaus and everything is good and dandy. So that answers that question. Let me just make sure we don't have anything else on Zoom. I think that covers it. Good. Yeah. So that looks like we covered everything. So guys, we did go a little bit longer tonight. I want to thank everyone for staying on. If you have questions about credit, reach out to us. If you have questions about life insurance, saving, reach out to us. The Sacred Account. If you have not gotten a copy of my book, Blueprint to Financial Freedom, grab a copy of that now. You can go to jerryfetta.com/B2F. Again, that's the letter B, the number 2, and the letter F. jerryfetta.com/B2F. You can grab that. Everyone have a great weekend, and I will talk to you next week.